Hey, welcome to my presentation about Onfolio SPV1, and we are rolling up a pretty fragmented B2B agency world. So here's a summary of the strategy. By purchasing controlling interests in complementary and parallel agencies, we can maximize returns, increase diversification, solve for the founder exit problem, and attract higher quality businesses. So agencies and productized services are very lucrative. They've got high profit margins. They've got small, nimble teams. They've got great growth opportunities. They're fairly easy to cash flow, and they often have very low capital requirements. So, everything that's great in business. And they also have a lot of traits that suit a roll up. So you can cross promote the services. They can often share back end services, systems, HR, admin, operations, vendors, relationships. They often have shared resources. They have pricing power if you've got enough of them. And less well known, but very important, is you can share best practices, things like marketing, sales, operations, innovation, things like that. Not only that, but you can acquire them at attractive prices. So the average purchase price is 3 to 4 times annual profit. So a business which is producing $1 million cash flow a year, you can buy it for 3 to 4 million. And that's a 25 to 33% cash return right off the bat. And I know that these businesses really go for this price because I've got a ton of deal flow, I've got a ton of opportunities, and these are the prices that people will sell for. But interestingly, agencies are often avoided by acquirers. I think smaller agencies can be too reliant on the founder. That was what I was talking about earlier with the founder exit problem. When the founder leaves the business, there's kind of nothing there. The sales drop, the operations don't work anymore. The evangelist of the brand is gone. Or those businesses don't have enough cash flow to hire sales reps. It's hard for them to scale, or maybe they're not diversified enough, especially if they're productized services. So a lot of acquirers really kind of turn their noses up at agencies and just prefer something sexier like SaaS. And this presents opportunity for people like us who have a bunch of wonderful agencies in our pipeline that we would love to acquire. The lack of buyers is what keeps many agency owners struggling to exit, especially where we are now in late 2023. There's a lot of agency owners who would be willing to take much more creative deal structures or just lower valuations, and basically willing to work with a buyer because they're just happy to find someone that wants to take over their business. So if you're willing to solve those problems about founder exit and diversification and small cash flows, you can acquire a diversified portfolio of cash flow positive agencies, add growth, add scale, keep teams excited to build, and sometimes even keep founders excited to stay on, and you can get some pretty lucrative returns. And that's what we do at Onfolio. This is our bread and butter, and I'll just take a quick minute to introduce myself to you. And so, for those of you who don't know me, I'm Don Wells, the founder and CEO of Onfolio. We are a publicly traded company on the NASDAQ, and we buy and build online businesses. I've been doing this nearly 10 years, bought my first business in 2015. Onfolio ourselves, we currently run about 30 businesses. It's a mixture of agencies, e-commerce, software, some online courses, some other services. And we've got about 25 team members, although some of our subsidiaries have 25 team members of their own. So across the whole portfolio, it's much larger. The businesses we buy typically range from around 500K to 3 million in annual revenue, around 500K to 1 or 2 million in annual profits. And this is what we do for a living. This is our bread and butter. We live and breathe this. And so we are the right team to execute on this strategy, and we're looking forward to partnering with you on it. We didn't set out to roll up agencies. Actually, we kind of acquired a few. We built a few. Onfolio itself started out as an agency, and through that, we realized that they're some of our best performing assets, and some of the things I've talked about why they're good, we kind of just realized through operating them. And I think that's why we're more comfortable buying agency than maybe others are. So what's our solution to some of these problems? Well, most agencies can be scaled a few ways. You can improve the operations. A lot of agencies are built by people who are good at sales, good at marketing, maybe good at product creation, but not so good at operations. And so we come in, we can improve those operations. That allows us to, let's say, improve the profit margins by 10%. We can add marketing channels, we can add additional services, we can add a sales team, and then, as I mentioned earlier, by rolling them up, you can cross-promote. So with roll-up opportunities, you've got a few different things. You've got horizontal opportunities. So let's say you own an SEO business, and then you just buy another SEO business, and then buy another SEO business and another SEO business. What you're doing there is you're increasing market share, you're increasing your pricing power, you're increasing your kind of negotiation power with vendors, and increasing your surface area in the space. Also, sometimes enterprise clients or large business clients, if they see a small agency, they might think, you don't have enough people for us to work with you. You're not big enough. So if you acquire multiple of these agencies, that can land those much bigger, more lucrative contracts simply because you yourselves are bigger and have more capabilities. There's also vertical opportunities, which a lot of people don't think about. So not just acquiring agencies, but acquiring their subcontractors or their vendors. It can improve margins. It can eliminate a lot of the margin, and it can control more of the ecosystem as well. And then, of course, there's synergistic opportunities. So let's say you own an SEO agency and you also buy an email marketing agency or a paid traffic agency or a content creation agency or a conversion rate optimization agency. So many opportunities. Or what we're trying to do, you can kind of do everything. So there's the horizontal opportunities we just talked about. There's the vertical opportunities. There's the roll-up opportunities, or all of the above. So, maybe we have a few SEO agencies, we acquire some of their vendors or subcontractors like link building agencies, acquire, let's say, a branding agency and a PPC agency, and they can all service the same clients, they can all send work to each other and so on, and ad infinitum. Now, this might sound at this point like a bit of a mess, but a key thing for us is, except where it really makes sense, we don't merge businesses after we acquire them. We keep them running separately, we keep them decentralized, it keeps them nimble, it keeps them closer to what really their clients, understanding their clients' needs, seeing what works, what doesn't work. It's how you come up with new ideas for services or products. And most importantly, it keeps people focused. And, all of this comes down to experience. We know how to professionalize a business at this size. So that kind of 1 to 5 million revenue size. We know how to improve its operations, its sales, and elevate its revenues. We've done it half a dozen times already. So what about the founders? Well, we've actually found that when you're building something bigger, not just us doing a standalone acquisition, most founders are actually excited to be part of that. And so they're excited to keep a small equity percentage. So maybe you just buy 90% of their business, which is, of course, a huge green flag when a founder is willing to stay and retain some equity. Doesn't necessarily, mean the business is fantastic in and of itself, but it's definitely a good sign. And the other thing worth noting is where a founder doesn't want to stick around or doesn't already have a CEO in place, we can acquire that business, which maybe is a little bit too small to justify hiring its own founder, and we can then add that to a division of one of our other businesses. And that allows it to kind of stay profitable without eating the profit by hiring a standalone CEO. Okay, so let's jump into some case studies. OutreachMama.com, this was purchased for $1 million in 2020, and the current yearly ROI is about 33%. So what did we do? How did we improve it? Well, we successfully improved the service. That means the quality of the service, the speed of the service. We successfully replaced the founder. I think he was doing pretty much all of the sales calls before we took over. And so how did we do that? We promoted somebody from further down in the business. They initially didn't work out and unfortunately moved on. And then we promoted the next person, and they worked out really well, and they're really evangelizing the brand. And we're excited about what Outreach Mum is going to do next. And we grew the bottom line. Ultimately, we grew at a small amount. There was a little bit of a dip at first because we decided, well, we need to improve the quality of the service, which naturally means you take on some more costs in the short term, but then that improved quality starts to result in more repeat customers, more word of mouth, more referrals, and you make more profit in the long run. Next one is SEObutler.com. We acquired this one about a year ago, late 2022, for $950K. We've successfully maintained its revenues, which is always the first thing we want to do with an acquisition. We're trying not to come in and rock the boat too much. We successfully replaced the founder, and we've built a platform for good growth in 2024. Rebranded, changed the credit system so people can buy credits that they can use later. The current yearly ROI is about 21%, so lower than Outreach Mama, but still, we're happy with that for the first year. ContentElect.com bought a little bit more recently than SEO Butler, just at the beginning of 2023, $850K that one. So ContentElect's biggest risk was that it was a content business, and with ChatGPT and AI coming out, are people going to hire content agencies? The other risk is a lot of its clients were B2B SaaS businesses that have just slashed their marketing budgets in 2023. And what we saw was that the link building services that ContentElect had were pretty popular. They were growing, they were high margin. And so throughout 2023, we've successfully pivoted ContentElect so that now, when we took it over, let's say 20% of the revenue came from links. Now I think it's 60 or 70% of the revenue comes from links. And that's because links have grown. It's not just because content has fallen off a cliff or anything. Again, we successfully replaced the founder. We hired a new CEO to come in. He's done a great job. And we've also expanded our product offerings with this one. We've added more link building services. And I think we added one more content service as well. So again, this one's looking like it's around a 21% yearly ROI. And we expect that to grow in 2024. GetMeLinks.com. This one was acquired early 2022 for about $2.9 million. Currently, yearly ROI is about 16%. So it doesn't always work out, fabulously. 16% is definitely not a bad return for. If that's our worst return, that's still pretty good. The reason it's been low is because we've completely rebuilt the back-end systems, improved the operations, again, successfully replaced the founder, and we've really significantly improved the service and the product. So as you saw with Outreach Mama a few slides ago, we took a little bit of a hit in the beginning when we improved the product and the service, but now it's on a 33% return. So, Outreach Mama's having a great time since we've done that. Get Me Links is literally in that process of improving everything and improving the back end. So the initial ROI hasn't been as good, but we're very excited about what 2024 is going to be. Now, not every business that we acquire in this SPV is going to need that rebuilding. So, you don't have to think, oh, okay, the first year is going to suck and then it gets better. It's really a case-by-case basis. We didn't have to do it with SEO Butler or ContentElect. And a lot of businesses in our pipeline right now, we're not expecting to need to do it either. So let's talk about why now. Why buy agencies now? Why get excited about this for 2024? So the macro environment, the increased interest rates, the kind of slowdown in the M&A world, the disruption that AI is potentially causing has a lot of agency owners struggling to sell their businesses. And that has meant that basically acquisition multiples have come down and seller financing has increased. So seller financing, meaning if a business is for sale for $4 million, instead of having to pay $4 million up front, Now you might only have to pay 1.5 million upfront or 2 million upfront, and the rest as seller financing, which will be paid, let's say, 2 years later as a balloon payment, or paid monthly through earnout payments or something like that. So that means that what we could acquire in 2021 for 4 million all cash, we can acquire in 2024 for 3 million total with 50% cash down. So the opportunity to acquire significant revenues and cash flows and profit is huge, because you don't need as much of it and the total cost is lower. So that's a pretty huge double whammy. And on Folio, we have some unique positioning. I speak at events. I've spoken at 3 events in 2023, 2 events in 2022. Got more speaking lined up in 2024. That means that a lot of founders are excited to work with us, to sell the business to us. It gives us a lot of opportunities. We're uniquely positioned. The fact we're a public company means we can offer a little bit more to sellers that others can't. We can offer them some stocks. We can offer them some preferred stocks, and just a lot of trust and prestige. So let's talk about some of our ideal targets. An ideal target for us looks like the following. It's a B2B service, so it could be marketing, it could be SEO, it could be email, it could be content, it could be paid traffic. It has a team in place. It's got 500K to 4 million in annual profits, and the founder's already been replaced, or actually is staying on, or they have a CEO in place already. Now, as you saw from the case studies, we're very capable of replacing the founder ourselves, but we'd rather not have to. So we operate in a sweet spot. We buy businesses that are in 1 to 5 million in price. That's typically too big for the average investor, and it's too small to interest private equity. So that means we're one of the best buyers in the space. We've got little competition, and as I mentioned, we've got a great reputation. We've got the added credibility and trust from being public. And to be honest, we rarely miss out on a good acquisition unless we don't have enough money for it, which is why we're raising money. So in our current pipeline, we've got a link building agency. The purchase price is about 5.2 million. It's making about 1.3 million in profit. So that's a 25% ROI before we even grow it. There's a domain and link agency. So they sell, let's say, expired domains. Purchase price 1 million, EBITDA 300K. So that one would be a 30% ROI off the bat. And then there's a full suite Midwest agency, so meaning that they're located in the Midwest. They get a lot of clients in the Midwest, so Iowa, Minnesota, that kind of thing. Purchase price of about 900K, and again EBITDA of 300K, which makes the ROI about 33%. Okay, let's move on. So, how does the actual opportunity work? We've mentioned we're raising money. We've mentioned what we're doing. We've mentioned why we're doing it. But what actually is the structure here? So we're raising up to 10 million into a special purchase vehicle, SPV, known as Onfolio 1 SPV. And so the SPV will co-invest with Onfolio into deals. So this keeps the SPV diversified and exposed to more opportunities. So by that I mean, let's say there's 2 link building agencies for sale for $5 million. The SPV is not going to buy 100% of both of them, $5 million each. Onfolio would come in as the majority owner. The SPV would co-invest with us, which allows us to capture more opportunities as well, because we have a kind of a partner investing with us. So it means all of us can be more diversified and can build something bigger. And as the minority owner, the SPV gets the kind of passive income side of things while maintaining the same returns. So how about liquidity? How about dividends? Things like that. So once we identify our first target, these businesses are already cash flowing, they're already cash flow positive. Dividends will be paid quarterly to all investors. So this isn't one of those like invest and never see a dime again things, like a lottery ticket that you might buy. We're not waiting for some IPO or some big exit to realize our returns. They're already cash flow positive, so we'll be sharing dividends with investors quarterly. There's also exit opportunities. So Onfolio is a long-term partner for our acquisitions, and that's why a lot of founders are excited to sell to us, excited to retain some equity, even stay running the business. And so, unless it makes sense to do so, we plan to not ever sell the businesses we acquire. However, we recognize that you guys might have different plans. You don't want to be in this forever. The dividends are nice, but how do you get your money back if you want to? And so what we're doing is once per year, we're going to calculate the value of your holdings and offer you the opportunity to exit to another investor or to us should you wish. So for example, let's say you invest 50K, 100K, let's go with 50. And then at the end of year 2, I think we're going to start with year 2 to give time for everything to kick in and everything. At the end of year 2, you say, how much is my 50K worth? And we look at it. We've grown some businesses. We've acquired some more. We might say, okay, your 50K is worth 65, and then you might say, great, I'm going to keep in. I'm enjoying the dividends. Or you might say, yeah, actually, cool. Give me my 65K. I'm going to cash out. And then there's a short window where we say, okay, cool. Let us see if another investor wants to buy you out, or if we want to buy you out. Give us a bit of time to organize that, and then you're out. Cool. But if you'd say, you know what, I'm going to stay in, then you sign on for another year. There's not like a weekly liquidity thing. It's once a year, a 3-month window, and then you're out. And I think that's pretty good. So let's talk about some of the example structures of deals. So for example, let's say there's a business for sale for 1 million. Onfolio would put in, say, 700K, the SPV. So you guys would put in 300K. And we would split that 70-30-27. Like, why not 70-30? Because we're not taking any management fees on the SPV. We're not taking a cut of your profits. So as it's a passive minority investment for you, we're just taking a couple of percentage points off the ownership. So if you put in 30% of the money, you might get 27, 28% of the actual ownership. And then so in the other example, 3 million business price, Onfolio puts in 2 million, SPV puts in 1. So the ownership split would be 70-30 there. And so in this scenario, assuming the business doesn't grow, it just maintains its revenues and its profits, your cash on cash returns would be 24 to 30%, depending on roughly what kind of acquisition price we pay for the business. So yeah, we're projecting around a 30% ROI. Now, we do this for a living. We vet opportunities all day, every day. The whole reason we're doing this SPV is we've got more opportunities than we can afford to buy. So we're just saying, come and invest with us, help us close more acquisitions. We can be more diversified. You can be more diversified. It can be a passive investment for you guys. It's going to be great. We can build something huge. And we have a positive reputation in the space. We've got proprietary deal flow. We're not just going on marketplaces. We have the ability to basically not convince, but persuade a lot of business owners to sell to us over anybody else. And we can move quickly. We've got acquisitions lined up. If we closed the SPV today, we could probably deploy 3-4 million within a couple of months. So the time is ready. The time is right, and the window of being able to get wonderful businesses at amazing prices might not be open forever. So let's summarize this. We're going to access our proprietary deal flow, our unique experience, and we're going to acquire a portfolio of agencies and productized services to maximize returns, increase diversification, solve for the whole founder exit problem, achieve scale, achieve synergies, cross-promotion opportunities. And what does the timeline look like? Well, we're in Q4 of 2023 now. So we've already incorporated the SPV in Delaware. That's what this lovely green check mark means. We've already built a pipeline of acquisitions. And as you can tell, we've already begun the raise. So Q1 2024, the plan is to complete the raise. We're not going to make this March 31st. It's going to be in Q1. So ideally January or February. We're going to complete our first acquisitions, and we're also going to continue building the pipeline. Q2, we'll pay the first dividends. This obviously assumes that we've made our first acquisition in Q1. And then we'll continue making acquisitions, and we hope to be fully deployed by Q3 or Q4. So what are the next steps for you? Well, if you're interested, visit this link, onfolio.com/SPV, and confirm your investment amount. You don't need to put the money in now. You just say, yes, I'm interested. This is how much I'm in for. And then when we're ready, we'll call your capital. We'll say, okay, the first business is ready. you guys need to put in, all of your commitment, some of your commitment, depends where we're at. And we expect the funds to be wired within 2 weeks. And then you wait and your dividends come in. And of course, we'll let you know when we've made acquisitions. We'll describe the business. We'll share the business so that you can see what it is you actually own. And the dividends will start coming in, like I said, the first full quarter after we've completed our acquisition. And then those dividends will increase as we deploy more capital and continue making acquisitions. So if I didn't explain everything well enough and you've got questions, you can email dom@onfolio.com. You can reply to the email that I sent you this video in. You know where to find me, but I would love to hear from you. I'd love to have you on board. And yeah, great. If you have any questions, let me know.